Lucian, you've spent decades analysing the property market at Savills, and you're one of the most quoted voices in the space. But today, I'd like to get your very data-led perspective that could perhaps help investors like me and our listeners cut through all of this noise on what's really happening in the property market, what's coming next, and what we should all be doing about it. So I suppose to begin with, you've been analysing the UK housing market for a long time now. When you look back at when you first started, Lucian, what are the biggest structural changes that you've seen in the market?
Yeah, so I've sort of been in property all of my working life, and I've had two careers within the business. I was a practicing chartered surveyor for 14 years, managing mixed portfolios with an element of residential. But I moved across to the research role in 2007. And of course, at that time, the market was absolutely roaring. And a lot's changed since then. Those sort of very strange days in the middle of the credit crunch and the GFC were probably as disruptive as any of I've seen. I think it's probably that and the pandemic, possibly a little bit of Brexit, have been the really sort of three big events when you don't really know what's coming next. Everything changes on a day-to-day basis. But I suppose the big things that have happened over that 18, 19-year period it is now, much more regulation generally, particularly in the mortgage markets. That has fed through to mean that in mature markets, you've sort of got past a period where you can expect house price growth that outpaces inflation. It's much more about working out where you are in the cycle to work out where you're going to get your capital growth. I would say real changes in tax policy. So I would say in many ways, tax policies, particularly around stamp duty, but also some elements of income tax, have been slightly weaponized to achieve political ends, whether that's been looking to, for want of a better phrase, and I'm not sure I quite agree with this, level the playing field between first-time buyers and buy-to-let investors. I think in reality, it's to put first-time buyers at something of an advantage within that. So that tax policy, particularly changing stamp duty, use of stamp duty holidays to stimulate the market when it was needed, big surcharges on people buying additional homes. I suppose that classically has been another one of the big changes. So, and now, of course, we've got 1st of May coming up. We've got a Renters' Rights Act going. You know, I started back in 1993. I was managing properties as we were really coming to terms with the implications of the Housing Act. 1988, we were seeing those old Rent Act tenancies drop off and get replaced by market rents. And what we're about to see now is probably the second big reform in that sector over the period of my working career. So there's always plenty to get your teeth into. And one of the things you try and do is take all of that backdrop and you match it with all of the data that goes with it. And that's kind of the fun of the job.
Well, I mean, it's not a short answer, is it? Because an awful lot has happened over the last, I've been doing this nearly 2 decades now and still very much feel like I'm learning, but it does feel, particularly the last decade, every single year there's just been something. And they've not been little things, they've been pretty substantial changes, real kind of structural changes in the way that we need to think as landlords and investors. And of course, I and our listeners, we're very much minded to be thinking about the decisions that we can make to make best use of our portfolios, maximize our rental income, improve our businesses, make our lives as easy as possible. And you mentioned it then, the data. Obviously, the data is what you're really interested in, and making decisions, making assumptions, I suppose, guiding things based on that data. I mean, from your perspective, Lucian, perhaps with an investor's capper, what do you think are the most important metrics? The 3 to 5 most important things that investors like me should be keeping an eye on, should be paying attention to kind of stay ahead of this curve?
Yeah, well, sometimes in the last decade, it's been very, very difficult to do that. I think one of the changes that I've seen over my career is there's a lot more real-time data, which is now available. And that probably puts you in a slightly easier position. We take a lot of stock by some lead indicators in the market. I'm a big fan of the RICS residential market survey, both from a sales and lettings perspective. It's a balance of opinion survey, and it's very, very heavily sentiment driven, but it is very good at early picking up changes in sentiment within the market, particularly in the sales market, in what happens to new buyer inquiries. And I think in the rentals market, given that you've got this consistent picture of constraints on supply, how much there's been changes in tenant demand. And of course, in the pandemic, or in the wake of the pandemic, when we saw some wild fluctuations in market conditions, that was very important. But there's a whole range of indicators that we'll be looking at. And partly it's then about how you interpret those. So, I'm a big fan of looking at where we are in the cycle. And that is from an investment perspective, that is getting a handle on where's the capacity for house price growth over the period of the next 5 years. And you do that by virtue of what you've seen in the past 5, where the affordability constraints are. So there's some great data, for example, in the regulated mortgage survey that helps you with that. And then I suppose, given what's happened to prices and capital growth, working out where you are in the cycle, where does that leave you in where the yields sit and where you can get your improvements in yield? Because, of course, in an era where you can't expect to see that capital appreciation that more than matches inflation, unless it's going to be in relatively short bursts, that means you're going to be much, much more focused on your income yield. And so there's the data there. And I would say in that respect, where are we now? I think we are sort of very much midway, possibly a bit further than midway through the second half of a housing market cycle. And that is where you end up with the lowest levels of capital price growth and still less attractive yields generally in London and the Southeast. And you've got more capacity for price growth. And you've indeed, over the last 5 to 10 years, you've seen more price growth in the Midlands and the North. Now, some of that's been led by Manchester, because Manchester has just grown and developed its local economy, feeding into the wider regional economy. But there is still very much that cyclical piece. And then even within that, that one of the things about the housing market is that, you can't just treat the Southeast as one. So if you look at where the strongest performance have been as late within the Southeast, then it's the Medway towns, and it's perhaps some of those slightly lower value markets that have remained a little bit more affordable, where you've still got a flow of demand which is coming outside of London. So that would also pick up places like Southend, for example, would also kind of come into that category. So that's, that sort of stuff is really interesting. I also like to look out from, this is where you get quite granular in the data, those places that don't necessarily conform to the cycle. And over the recent past, a classic example, I say recent past, probably the last 15 years, right? Bristol is a classic example of that. It's not really worked through the cycle. It's really developed its own momentum. It's changed a lot. It acts in that Bristol Bath conurbation acts quite differently, for example, to the rest of the Southwest. And it's getting into the nuts and the bolts of the data around that. I think other things that we'll look at, we'll look at some of the other sort of metrics around where loan to value ratios are. We've played, our understanding of the mortgage markets has grown massively. So what's the forward outlook for interest rates? How's that already translating into mortgage rates or the cost of fixed rate mortgages? I do quite a bit, for example, about, a model around whether cost of buying or cost of renting is most favorable. A lot of people get that wrong in terms of the way that interpret it. So there's a lot of stuff in there that sort of keeps us on our toes and gives us a lot of metrics just to try and help us work out where we are and what the prospects are going forward.
Well, like you said, there is so much data at hand now. And one of the interesting things about that is it's accessible to so many of us. There are some, of course, reports and sets of data that you might need to be paid or a subscriber to be able to access. And I get some of them, particularly from, for example, the student market. There are certain providers and authoritative figures, I suppose, in that space that collect a lot of data from accommodation providers in the student market space, the purpose-built sector, universities, which is very interesting, but also very niched. But you've raised some really unique points there, Lucian. And I want to dive in, and this wasn't on my list today, actually. I just want to dive in a little bit further on this idea of the cycle. I don't think anyone listening today will be unfamiliar with the idea of a cycle or a property market cycle, but I think what most people probably have in their head is this idea of an 18-year property cycle where their prices double, because lots of gurus on Facebook and Instagram seem to shout about this an awful lot. Can you tell me what your interpretation of a market cycle is? Help us understand what you are actually talking about when you think about market cycles.
Yeah, so I think there's two elements to a market cycle, right? There is one, the sort of underlying UK picture. Are you in a period where there is capacity for strong growth? So typically what happens is you would have a downturn. You would have a period after the downturn where the market corrects, affordability improves, but people aren't confident enough to take advantage of that. As confidence builds because the economy grows, then you tend to go into a period of strong house price growth. What you then tend to find is affordability again gets stretched, and that can be in any part of the market. It can mean that it's much more difficult, for example, from your buy-to-let investment to make all of the maths stack up, particularly where you're carrying debt in that environment. You get to that point, and then the market has always had a tendency to go on a bit and go on a bit further to that. And that's when you get to those affordability pinch points. And then normally something happens to restart the cycle again. You get a correction and off you go. So that's one part of it. I think our susceptibility to some of those cycles has probably been reduced because we have got a more regulated approach to the availability of mortgage debt. So that, if you like, acts as a brake on the ability for the irrational exuberance that you get at the back end of a cycle just to continue and to run on. Classically, that's what happened in the late 1980s. Markets just sort of ran on with some very strong house price growth. People got carried away. It happened again in sort of 06, 07, where you had another burst of house price growth. In theory, that shouldn't have occurred. And you had it in London, particularly in London in the run up to about 2015, 2016, when we started to see the flip back to other areas. So you have that part. I don't think that is an 18-year cycle. I don't think you can pinpoint a time on it. I think other circumstances will dictate how that works. That can easily be affected by one-off events. And my God, we've had enough of those over the recent past. Very hard to predict. We call them black swan events. They make it phenomenally interesting to analyze a market, but they are almost impossible to predict, which is very frustrating when you look at the accuracy of our house price forecasts historically. So that's one part of the cycle. The other part of the cycle is very much geographical. And a piece of work that I first did probably 15 years ago was to try and separate the country into what I called leaders and laggers. And that was a market where you looked at the strength of performance of local markets, and you saw those which performed very, very strongly in the first half of a housing market cycle and led, and then they sort of tended to lag in the second half of a housing market cycle, and then you saw the picture move. Now, you can do that quite easily on a regional basis by looking at the ratio between regional house prices and the UK average. Right? If you just run that chart using the nationwide data that's available, that gives you an idea where you are in the regional part of the market. And generally what happens there is London and the South East kicks off because that's where you tend to get the economic impetus first for the market to kick on. You get the strongest growth there. You tend to find the Midlands, the North, Scotland and Wales get left behind in that period. Second half of the housing market, it flips. And you've got more capacity left in the Midlands, the North, Scotland and Wales. Scotland and Wales can be really quite late cycle markets in that respect. And then the thing flips around. And it's that sort of, I think we're halfway through that second part, if you like, at the moment. And then you have the local variation within that. And, that's the bit where you need some fine-grained house price data. And we have some much better fine-grained house price data because we have an ONS index that goes down to a local level. But you need to be quite cautious in how you use that. You need to avoid that sort of temptation to look at short-term price movements where there might not be that many transactions and you get a lot of volatility and noise. You sort of need to look through that and go a bit more medium-term in the way that you look at it. And I would say that's kind of one of my pet hates at the moment is that, people place too much stock on what's happened in the last month to rents and capital values, right? What happens, that precise reading depends very heavily on the robustness of the index that you're using. You need to look through that, and you need to be looking at 3 month on 3 month or 6 month or 12-month movements. Otherwise, your eye will get taken off the ball, and you'll come up with the wrong conclusions. So there's lots in there.
I mean, it certainly is the best justification for a cycle that I've ever been given. And I think you've, in one swoop, just kind of kiboshed the idea that this 18-year thing is a real thing. I think you said it yourself. Sentiment plays a big role in what tends to happen in the property market. But I think looking back historically, it's quite easy, isn't it, to box things up and say, well, every 18 years, things tend to double. When in reality, actually, that's certainly not what we appear to be seeing at the minute for lots and lots of reasons. And I've always urged, a degree of sort of control and kind of pursuing that narrative too heavily, because I think it is extremely speculative. And I think a lot of what you've just said makes an awful lot of sense. And I've always thought that as an investor myself, my job is to conduct the orchestra. I've got the instruments and the people that are in the orchestra, and I can pick and choose how to use those instruments. And the data is certainly part of that instrument, but a set of data does not give you the whole picture. The real skill of being a good investor in the property market, I firmly believe, is being that local expert, being on the ground in your location and being able to take all of that information, look what's going on elsewhere, and combine that with what you're seeing and feeling on the ground locally, and pull those pieces together and make decisions based on that. And I think that people often like to look around and look for, an answer from somebody like yourself or somebody like me. But in reality, you still have to know on a micro level what's happening. Combine it with the macro data, don't you?
Yeah, completely. And a way that we do a lot of our analysis is we start at a national level. And generally at a national level, you look at how things have moved over time. That gives you a very broad picture as to the sort of the main dynamics of where the market is. You then go regional, because that gives you a picture, and there should be enough data there to get a robust regional picture. And then what you're doing is applying what you know regionally to a local market. And there is much more data that's available at a local market, whether it's census data, whether perhaps it's the ability to get your hands on Experian data. We're very lucky in that we have access to a lot of the data that is provided by the main listings portals. That's where you feather it in. But equally, you talked very recently about students, right? And we have seen a student market, whether it's purpose-built student accommodation or whether it's the HMOs of that, which for a long time looked like you invested, you were guaranteed on the returns. You didn't need to be too selective to make the thing work. The market will probably bail you out. That's changed, right? That purpose-built student accommodation market or the HMO market for students has changed, because a lot is changing in the education industry. And that's where you can make mistakes unless you get into the local data and you get much more forensic about where's supply, where's demand, and it's supply and demand. It's all supply and demand, right? And what's likely to happen to those. And it's about spotting those fundamentally undersupplied or poorly supplied markets, because those are always the markets to invest into, I would say. So I think you've got to start national, go regional, get local. And some of that local stuff is, I remember my, many years ago, back in the late 1980s, when I did A-level geography, my geography teacher said, geography is learned by the soles of your feet. And there is a definite element in that around property investing, right? You've got to walk it and see it to get the picture.
You really do. And I'll use the student market as another example. You could be looking at a property on one side of the street and it might work really, really well and it might perform really well. And something on the other side of the street or a bit further down the road could have a completely different outcome. And it's understanding why, and it's the experience that gives you that. And it's very difficult to explain why, but there are trends in communities, types of people, the way that people like to live, and also other things that are going on. The top side of a road, there might be some more challenges on a local level that, crime and things like that. And actually, it really does pay dividend to understand what's going on. There might be some local infrastructure projects, things that are happening, maybe extensions of campuses, or maybe some new amenities that are being built nearby. These sorts of things, I think, can heavily influence our decisions.
And those are the bits, right? Those are the bits that tell you whether you're going to underperform or overperform the market, right? And that's, again, you go national, you go regional, you go local. So you work out what the regional outlook is, and then you're saying, given all of this stuff I know locally, what does that tell me about whether or not I'm going to under or overperform? And if you don't do that last bit, you're going to get it wrong.
Precisely. The one way I've always tried to communicate this to the people that I work with and our listeners on the show is that there's an element on the spreadsheet. We're all familiar with putting an analysis together, looking at the numbers. We're going to buy it for X. We're going to spend Y on it. It's going to be worth Z. And we're going to do all these things in the middle. But that lives on the spreadsheet. There's all of this stuff off the spreadsheet that you can't put into a field. You can't make automatically calculate a result. You have to be able to interpret it. And I think that that's the real art of being a good investor. I mean, you've talked about a number of things already, Lucian, and I think this is a fascinating conversation. If we look ahead, just 12 or 24 months, on the near horizon, let's say, what do you see as the main pressure points being? What are the things that we should be paying very particular attention to, either good or bad?
Okay, so from my perspective, in terms of the outlook, you've got to watch inflation right now, because what happens to inflation is going to tell you what happens to interest rates. And what we know at the moment is that the mortgage markets are very sophisticated. They are very quick to pricing changes on the outlook to interest rates. And fundamentally, for a recovery in the housing market, which has been very, very slow to materialize since we saw that steep increase in interest rates, you need to have easing affordability. And that easing affordability brings more people into the market, and it gives those who are in the market more buying power, right? And that's fundamentally what underpins house price growth. And that really doesn't matter whether you're an owner-occupier buyer or whether you're an investor buyer. Those things offer. Other things to watch around that, mortgage regulation, I think at the moment is really interesting. So you have got a government with a very strong house building agenda, but not very much money. And it's trying to get house building up when the market is weak. That's hard, right? Whatever they've done around planning reform, which is substantial, you can sort of understand why that's yet to bear fruit, because you haven't had the economic conditions right to sit behind that. So what they've done is basically go to the FCA and say, do you reckon you're a bit tight on mortgage regulation? Is there anything you can do on there just to loosen things a bit? It'll help us with our objectives to get first-time buyers back into the market. Can you ease that back a bit, or just have another look at that? And essentially, we've had one round where the FCA have changed their guidance on how lenders use mortgage regulation. That's opened up more capacity. So you've seen, for example, Nationwide are offering more products at higher loan-to-income ratios at the moment. But you've also got a consultation on how they go further that will be conducted this year. So if that widens the pool of buyers and their buying powers on top of the interest rate cuts, then you can start to see that provides a platform for house price growth. And then you've got to follow underlying levels of consumer sentiment, because that's the bit, if you like, where you're looking at, yes, the affordability's improved, but people aren't confident enough to take advantage of it, right? So you're looking for that point in time, if you're really sort of, is now the right time to buy or not, or how long have I got to wait? Just look at where that sentiment is. Of course, one of the things that, we would say, I've not really been into property investment personally in a big way, but I have always sort of timed my next house purchase very carefully. It is usually the case that you do best when you trade in a weak market rather than in a strong market, because there's less competition, because you're in at that period before you get the price growth. The issue is, for most people, they don't have the confidence to do that unless they see others doing it, because there is a confidence. And you've got to be pretty sort of, I'm going to say long in the tooth, but you've got to be pretty experienced to sort of have that underlying nous to say, okay, they're holding off, but I think now is probably the right time to go in understanding that cycle. And then the other big thing, right, we've got to watch quite closely how the Renters' Rights Act plays out in terms of landlord and tenant behaviour. That's the other big one. So at the budget, we know we've got that coming. We also know there's going to be an extra 2p in the pound on income tax for private investors on their rental income. What does that mean? What do those two things combined mean for the structure of the industry? Everything tells us it should become more undersupplied. And I use that phrase because it is fundamentally an undersupplied market, right? That's one of the reasons why the institutions love a bit of build to rent. It's undersupplied. But I think you are going to see a number of other landlords. They're hitting those later retirement years. It's not really making the money that they wanted. They've done pretty well out of capital growth prospects since they first invested, and some of them are just going to go, now is the time to cash in. So I think you will see a bit more stock come to the market. I think that would offer opportunities for the slightly more committed, probably larger, wealthier landlords to be able to step into the shoes of some of those. But at the moment, some of that's theory, right? We've got to see how that plays out, and the market can do all sorts of wonderful, quirky things in between. But I think those are probably the things that I'm going to be looking for.
And what would have to happen? What decisions, what changes would have to be made for us to suddenly accelerate I suppose, the house price growth, maybe yields, for things to start looking substantially better from the perspective of an investor, anyone buying and trading in real estate?
Well, I kind of guess it depends on what you want to look for, right? So if you want to have growth in rents, let's just say you've purchased. So you've got the deadweight costs of your investment that are already in. You've set your base value. You're probably, in some cases, looking at the return on purchase cost as much as you are on current day capital value. Then you want to get some rental growth out. To get that rental growth, you need an improvement. I would say you generally need an improvement in economic conditions, right? And this economic recovery has been relatively slow. That, aligned with regional wage growth, just gives people a bit more capacity to drive that rental growth as you go forward. And I would say from there, if you've already purchased, then it is about some of the prospects for capital growth. I mean, you can't eat off the table of capital growth unless you realize it, right? It's something that you tend to take advantage of at the point of exit, or where you might want to expand your portfolio and you can say, look, I've got this much equity in it, to your lender, got this much equity, therefore I'm de-risked, therefore I'm a good bet, then I'm going to crack in. That is more about the fundamentals that we've already talked about, actually. It's about interest rates. It's about the way mortgage regulation is applied. And it's possibly also a little bit more, that tax policy piece, I think, also comes in for investors. So a bit of deregulation, lower cost of debt. Then you start to get the capital income growth. But from a rental perspective, it's going to be about where does the economy sit? It's going to be about some of the fundamentals, for example, in the student sector, as to whether or not you pick the right location, what's happening around admissions, competing supply in all of those markets.
On the point of deregulation, I understand your reference to, for example, the FCA, just loosening maybe some of the lending criteria that banks are allowed to play around with. But what about the prospects of substantial deregulation that perhaps, maybe a different government would bring in? Do you think that is just perhaps a pipe dream for investors? Do you think any of the changes, because we talked about this on another show together recently, and it was quite clear that there were some strong opinions that some of the changes that are being brought in by the Renters' Rights Act will have quite sort of debilitating sort of outcomes, and whether or not they're unintentional, we'll leave for somebody else to answer, but certainly don't appear, in theory at least, to actually help the end user, which is the tenant here. And if that, these changes continue to maybe compress the problem of undersupply, at what point does somebody have to kind of say, look, this hasn't worked, we would have to do something quite different? Is the idea of rolling back any of this legislation a complete pipe dream? Or do you think that we could end up in a position where some of the changes that have been made will force somebody, a new government, into those very difficult decisions?
Well, I think that one of the important points you've just made there is a new government, because the first thing that we know is that some of the changes around the Renters' Rights Act have got quite a lot of political ideology behind them. And you could see that in the way that it went through all of the discussions in the Houses of Parliament and the House of Lords, and there were practically no changes, right? This was about getting it through to give tenants more security of tenure. You look at some of the specifics in there about things like rent review, about the ability to use some of the notices, the length of period of those notices. And then if, for example, you want to sell it, you can't sell it, and then you've got that limited period where you can't bring it back to the rental market. There is an element in there that I think is going to be difficult. I think over the course of the remainder of Parliament, this Parliament under this government, you can only expect nuanced change, right? Then there's one area that's an example where they've left the door open, and that is around the rent review process, right? So you serve your notice to get your rent review. The tenant works out that the increase only comes in when the tribunal's made its decision. We're all concerned about whether or not there's any capacity in the tribunal system to hear this. So there could be quite a substantial delay there. And their tenants work this out, and so they just challenge, right? Because they know they can delay their rental increase for X months, whatever that figure X might be. At least the current government have looked at that and said, oh, yes, that is a bit of a risk. So we will review that. It will be interesting to see whether they review it in other perspectives. I think prospects have changed from other governments. Let's not forget the Renters' Rights Act really is a reincarnation of the Renters' Reform Bill that was under the previous government. Now, how much of that was really driven by the ideology of Michael Gove when he was Secretary of State, and how much that will be adopted by either the Conservatives or say Reform or whoever else going forward is a bit more interesting, I suppose, going forward. But again, I think there was an imperative for change, and that imperative was change as you got more people in the rental market, they're more diverse, and often they're in different life stages than they would have been back in the 1990s, right? So you've got a lot more families with children, and I think that sits behind a lot of the change. So I don't think you'll see wholesale change in that respect. Equally, I don't think you'll see things tighten substantially from here under the existing government. For there to be a change of government, you could see some of the changes, some of the stuff that actually has those unintended consequences. I think you could see that. I don't think, however, you will see the return of the assured short-hold tenancy agreement anytime soon. I personally would be quite surprised around that. Some of this, of course, goes hand in hand with the underlying political desire from all parties to get more people into home ownership. Fundamentally, this is where a lot of this comes from, because they see that when you get people into home ownership, that in theory gives them financial security, and that financial security is a good thing for the wider economy generally. And a lot of the measures that you're seeing around deregulation at the moment are to try and improve numbers of first-time buyers. If that works, then there is less of a need to row back on some of the stuff that you've had in the Renters' Rights Act. If it doesn't work, then the problems that have been widely discussed are going to become apparent more quickly. So I think you're going to have to look at, it's not just about the politics here. It's also about, and it's not just about the politics of private renting. This is also intertwined with what happens to first-time buyer numbers and owner occupation, whether some of the other things that the current government has put in place last. But, every political party, whatever their colour, likes to see people get on the housing ladder.
And actually, I don't think anybody, certainly that I know, has a different viewpoint on that either. I guess the big question is, can it be done? And can it be done without hitting these house building targets? I mean, what is your opinion on this? The notion that they could build 300,000 homes a year doesn't look like it's plausible, even from the perspective of being able to put materials on the ground, let alone actually get sites through planning and get contractors and home builders to be able to stick their necks out far enough to build that many homes. I mean, was this a vote spinning exercise? Could this happen? I mean, what's Savills' opinion? What's your opinion on this?
Yeah. So, I mean, I would say generally 1.5 million homes over the course of the first term was bold. It was pretty brave to have that as one. Was it one of your 6 key pledges? It was something like that, and comments like "judge us at the end of the first term on our results in this area." That was bold, possibly naive, right? Because turning the house building industry round and increasing house building is like turning a battleship, right? You've got to make the changes in the planning system, and I think a lot of the changes in the planning system are good, right? They're like a jigsaw. You've done the bits around the edge that you need to do to complete the jigsaw, but it takes a long, long, long time to fill it in the middle, particularly when you've got some of the practical constraints. Where do the bricks come from? Where does the labour come from? How often, even when you make the big changes in planning, that starts at a national level. How long does it take to feed through to a local level? That takes time. That creates friction in the system. So for a lot of people at the moment, particularly the larger developers, they know that their chances of getting a consent are up, but they also know there's going to be a resistance at a local level, and therefore they're probably going to have to go to appeal to do it. And that means there's still risk in the system. And that means that it is still more difficult for the small and medium-sized house builders. So all of that makes it difficult. And house building last year went down, right? In England, it was about 210,000. I think we ended up the year at. Again, if you haven't got the economy with you, it's not going to, and you're not bringing more developers into the market, then that's going to take quite a long time. That's going to take quite a long time to tick back up the other side, not least because, you've got to find the bricks. And one of the favourite charts that I've done in the last 2 years, and it's really sad to say you've got favourite charts. I acknowledge that. My wife tells me on a regular basis that this is not a good thing. But I was literally jumping through hoops around the office when I got UK brick deliveries going back to 1948. I mean, I managed to get that out of the ONS, and it tells you a story, right? It tells you a story that you need the materials, and we've depleted our ability to get the materials to do some of this thing. That means you put more pressure on the existing stock. That's fundamentally, and there's going to continue to be pressures on that. We're going to continue to have an undersupply of housing, and I think and that's probably going to be exacerbated in the private rented sector.
So, I mean, what I'm going to take everything that you've shared today, and I'm going to, with my investor cap on, I'm going to share my viewpoints on where kind of how I feel as an investor right now. I think this might be useful context for our listeners. You're talking about a mid-cycle position. And at the minute, inflation is, it's come down, but we're teetering, aren't we? Is it going to come right down? Is it going to go back up? It's not clear. So we're certainly not in the safe zone yet. And I don't think anybody would want to put money on exactly where we will be in the next 6 to 12 months. But we're certainly in a better position than we were last year. It sounds like undersupply fundamentally is an ongoing issue for the PRS, for the market. And that isn't going to change. There is no solution at hand right now to fix that problem. We've talked about macro, micro viewpoints and the importance to interpret that sort of information. So let's assume that as an investor, I understand my micro market and I know where the good places and the good homes and things are to make it work. I see this as being quite a good place in the market, actually, Lucian, because prices aren't running away. It's not that competitive to buy at the minute in the market. There's a lot of scope to do really great things with accommodation that is tired, that is old. Tenants clearly need this. It's the only way, I think, to can maybe soften some of the blow of the Renters' Rights Act when it comes in. We need good relationships with our tenants. We want them to stay in our homes. We're going to have to up our game a little bit. So I see opportunities to do this. And I think with that long-term view, you mentioned, you've got to be long in the tooth at the minute. I do have a very long-term view. I think short-term, it's about buying good assets in good locations at sensible prices. It's not about getting the very best return on paper, and it's certainly not about expecting to pull all of your capital out, on the first refinance. It's probably the case that you're going to be waiting a little bit longer to maybe see some of that capital appreciation. But I think right now, if you gave yourself a 5 to 10 year sort of timeline, I think that the market looks, caveat being black swan events or maybe what Putin might do or something like that, it looks like a pretty stable market. And that's better than I think we've seen in the last 5 or 6 years by a long, long way. I mean, do you think that that's a fair assessment, or am I being biased? Because I'm conscious I could be being biased as an investor.
Yeah, no, I mean, I don't think you're wrong at all. And of course, some of the trickiest market conditions you would have been in the immediate post-pandemic boom, right? When you had a ridiculously competitive marketplace, there was always some sort of extraordinary behavior that was going on there where you could easily have got your fingers burnt very, very quickly if you're buying at the peak of that market. You're not in that position at the moment. You are in a position where mortgage regulation is going to be eased back. You're going to be in a position where the cost of mortgage debt is going to fall. And you are in a position where house price growth last year was 0.6 of 1%. Right. So that again tells you it's not a massively competitive marketplace. And the improvements in affordability that we've seen are yet to feed through into house price growth. If we've got all of that right, then that tells you it's not a bad time to be investing. I suppose the one thing that you would hope for in doing that, and it goes back to your previous question about what might change from a political perspective. I think you could see some nuanced change around things like the Renters' Rights Act. But I think a new government coming in probably would be more likely to make a change around tax policy. Because it's easy to affect overnight and it can provide a very direct stimulus. And that might be rowing back on the stamp duty surcharge, which is pretty mighty, running at 5%. And it might be having a look at actually some of the restrictions on income tax relief, admittedly for private individuals. We know that the bigger people are more likely to have it in a corporate structure. But that, I think you possibly could see on a changing government. I think it's easier to work through. You could do that within a budget rather than having to push a big housing bill through Parliament. So, yeah, that's going to be an interesting perspective, I think.
Interesting. I've got a final question for you today, Lucian. And in some senses, you've probably already answered this question. We've kind of touched very briefly on the idea of institutional investors, the build-to-rent sector. With the backdrop of the Renters' Rights Act, the general sort of direction of travel in terms of legislation, regulation, the public opinion on landlords, it does seem to me that institutional investors are now looking better placed than even smaller landlords, in this game. Do you think that that is a fair assessment? And do you think that that means that the small investors or even private investors themselves need to think quite differently about how they build, how they run, how they operate their real estate businesses?
Yeah, there's certainly going to be disruption from that. What I think I would say is the underlying appetite for that build to rent investment remains strong, because I think the whole idea of going into an undersupplied market where you have set up the platforms to get over the issues around the granularity of the asset, which is the thing that we were always told held them back, is good. The issue that build to rent have at the moment is that the returns come out don't sit that comfortably against gilt yields. You're getting such a strong return on gilt yields, then actually are you going to get the compensation that you need in terms of offsetting all of your developments and operational risks within that market by going in right now? So we've seen quite a lot of build-to-rent development that was started X years ago hit the market in the recent years, but we haven't seen that much start on site. I think that comes back first in what is referred to as single family. So that is suburban housing for slightly more midlife renters. When I say midlife, I mean sort of young families rather than graduates or younger households. I think it starts there. It fits much better with the house builder model. So it's easier for them to deliver. The demand is probably a bit securer. You're not necessarily outlaying capital in quite such big chunks, and you haven't got the same issues of development viability in those markets because you haven't seen quite the same ramp up in terms of building regs, right? So that I think is where it starts. It comes to the multifamily, which is the big blocks of flats later down the line. That said, what are the lessons that we can learn from build to rent? One is that there is a real desire and a strong pool of tenant demand for a well-serviced offering behind a brand where they know the boiler is going to get repaired very, very quickly, right? Where they know that the processing of their tenancy deposit is going to be absolutely immaculate, where they know that they can call on hand and get a repair done to the property very quickly. And if you look at the way that that's manifested itself is we've talked a lot about local markets that you invest in as a private investor. To an extent, build to rent have less of a concern about that because their product offering is different. They will pull rental demand from a much wider area than the small private investor with individual assets, because their offering is differentiated in that respect. And it will be a challenge for some private investors as to how to respond to that, particularly if there's a big build-to-rent scheme on their doorstep. And perhaps that's another bit. Let's go full circle. Perhaps that's, again, where my geography teacher comes in. Go around, look at it, and understand whether there's going to be that competing supply in your local market.
I just bought a site that we subsequently got planning on, and it was just, a couple of doors down from a kind of development done by Capital Incentric, who are, a superb developer doing exactly what you've just said, branded living with some communal features and really kind of reinvigorating some of the sort of tired residential landscapes. And I looked at that as a fantastic scheme that has actually reactivated an area that historically probably not been the first choice, in all honesty. Probably wasn't going to command the values. It needed someone like them to come in, set the precedent, proof of concept, and then the door is open. And I think there's some really interesting opportunities like that happening around as well, which, again, you need to be on the ground, stomping the streets to actually see and feel what's going on. Lucian, this has been a really fascinating conversation. I could keep going, but I won't. I want to say thank you. I really appreciate you coming on today. It's been great to get your take on the numbers and what you think is actually going on, what landlords and investors like us should be doing, what we should be paying attention to in 2026. Before I go, though, Lucian, for anybody listening today, for anyone who wants to follow your work, maybe read, more about your thoughts, your opinions, where can they best keep up with your musings and anything that you've got to share?
Yeah, so I abandoned X some while ago for reasons I don't think any of us really need to go into. So from a social media perspective, I'm much more active on LinkedIn. And if I tend to find something that interesting or excites me, then you'll find the odd graph. So if you like the graphs, then you'll get some stuff out of LinkedIn. And generally, all of our big publications, I will post on there so you can see what we're thinking. And alternatively, you can get onto the Savills website. You need to go to Insights and Opinion and into the research section, and then focus on the residential stuff there. So it's a bit of a journey to get to it, but hopefully it's rewarding when you get there. So that's where most of it is. But often I will pop up on podcasts and webinars, and I probably present to people probably about 100 times a year. So that's up on my feet talking at various conferences. So I did the ISA AEW, so Chartered Institute of Accountants in Wales, residential investment seminar just before Christmas. So, you might see me popping up where I'm desperately trying to prove that I'm not a mild disappointment in person.
Well, I'm sure there's going to be a lot of people finding their way to all of these different platforms and channels, Lucian. Like I said, it's been an absolute pleasure. Thank you so much for coming on today.
My pleasure.